Hi, and welcome to this episode of Perspectives. My name is Corey Clermont, product specialist here at DoubleLine Capital. And today I have the pleasure of being joined by Sam Lau. Sam?
Hey, Corey.
So Sam is a portfolio manager here at DoubleLine. He is on our macro asset allocation team. He's been working with the DoubleLine team for nearly 2 decades. So the topic for today is equal weighted indices. We're going to talk about it in the historical context. We're also going to talk about it in the context of today's market environment. And lastly, talk about the merits of an equal weight allocation to your portfolio. So Sam, starting from the top, can you talk about the fundamental differences between equal weighted indices and market cap weighted indices?
A lot of investors or even watchers of the market are probably familiar with the idea of market cap indices, even if they don't know it. The S&P 500 is a market cap weighted methodology that's used to construct that index. So what market capitalization means, it's the number of common shares outstanding multiplied by the sales price or the price of an individual security. All of that goes into the S&P 500. So those with the higher market capitalization, because it's weighted by that, have a higher weight within the S&P 500. Conversely, the smaller market capitalized names have smaller weightings within that. So again, it's just a basis on which to construct the allocation within the constituents of an index according to the market cap size of each security underlying. Equal weight, also as the name suggests, is based on more of a balanced approach in terms of thinking about how to allocate to the name. So the S&P 500 has an equally weighted version. Within there, let's just use the idea that there's 500 names at any given point. Within there, each one would have an equal share of capital allocated towards that weight within the S&P 500. Using that as a construct, that amounts to 20 basis points or 0.2%. So that is kind of the foundation for thinking about how you might see differences in terms of either the composition or eventually the performance. So when we start thinking about the current setup of the S&P 500 as it stands today, there's a heavy concentration in the highest capitalized name in the S&P 500, where if you take a look at this chart that we have on the screen, starting first with the equally weighted names in the yellow line that goes along the bottom of the horizontal axis there. Along the horizontal axis, we have the number of constituents and in terms of rank order of what their weights would be. And the reason why that yellow line is horizontal is it goes back to the 0.2% weight for the equal weight index. When you start looking at it from the market cap S&P 500, just the standard headline S&P 500, you can see the top 10 names occupy about 30% of the overall index, concentrated in just 10 names, with the largest being around 7%, the smallest being somewhere around just north of 1%. And then you move to the next 25, and then the biggest names, that accounts for a pretty significant percentage. We'll get that in the next chart. But all the way down, when you start to look at it, it's not until you get to about the 100 or 110th name based on market cap that you start to get to that same weighting scheme as what you see in the equally weighted in terms of each security at 0.2%.
So around 20 basis points.
Around 20 basis points, right. Yep. So at around the 113th name, as I saw it on Bloomberg today, after that point, you start to see an underweight relative to the names that you see in the S&P 500 market cap versus the equal weight. So the first 110 names, you have an overweighting to those names relative to the equal weight index. The remaining 390 names or so are going to be underweight that of the equal weight index. So that's pretty interesting in itself, as it's fairly top heavy.
Right, and relative to the last 25 years, this is the highest level that we've seen the top 10 names account for from a cumulative perspective, right around that 30% mark. So.
That's right. And over time, I mean, a lot of that comes down to this idea of what's known as the momentum factor, right? So if you have positive momentum in some of the more larger cap names, I think people are throwing around the term mega cap names right now, especially when they're talking about the top 10. If those start to drive performance in the positive way, then with momentum, the way that these market caps indices are constructed, because they don't rebalance, the outperformers can continue to grow as an increasing weight within the overall index as long as that positive momentum continues. And that's why when you think about the market cap indices, they tend to have or exhibit a momentum bias to the performance relative to something like the equal weight indices, which tend to have a bias towards mean reversion, given in part this rebalancing function to bring each one of the names back to that 20 basis points, assuming 500 names, on the periodic rebalance. So when you think about it from that construct, the positive momentum helps market cap indices, especially if it's occurring at the mega cap portion of the names there. And with it, it's kind of this concept of letting it ride, right? Yeah. You continue to ride the outperformers. They continue to see an increase in the allocation within the overall index versus something like the equal weight where you're constantly rebalancing. It's not to say that the outperformers don't exist in the equal weight index. They do grow in size, but when it comes to that time for the next rebalance period, they're brought back down, and you have that somewhat of that rebalancing effect, which tends to outperform in a mean reversion.
Thinking back to really since the beginning of 2022, you've had this really strong growth within the equity market, and it seems like it's been led by a handful of names. And year to date, that narrow run in equities has largely continued. So, and given the current market backdrop, does that make the attractiveness of an equal weight allocation more?
You're already starting to see some cracks form, within this idea of this concentration of momentum within the top names, where going into 2024, there's two names out of that Magnificent Seven that are actually underperforming the S&P 500 pretty massively. We're talking about, I can't remember, I think the S&P through yesterday is probably up 6 or 7% on year-to-date basis. These have negative signs. These two that dropped out have negative signs in front of them. So very quickly, over the course of the last, let's call it 16 months or so, the Magnificent Seven has dropped down to, 5 names. Some people are calling it the Fabulous Five. Let's see if it sticks. But that's kind of the idea of mean reversion too as well. So when you think about, momentum stocks, momentum within, broader, equity indices, it's quite attractive. I mean, you can see the appeal there, right? Yeah. You want to get into something that's a trend where you're getting the positive momentum. If it's being carried by some names, you start to see these monikers come up, that sound, pretty interesting. The Fangs, the Fangums, now the Magnificent Seven, now the Fabulous Five, but it sounds catchy. The term FOMO kind of falls into this as well, as you see these equities names increase in value and they're driving the S&P 500. You want to kind of pile into it, and that makes a lot of sense. But people have to remember that momentum kind of cuts both ways, right? It sounds great when it's positive and you can get that price appreciation. You can see the value of your portfolio grow. But we have a saying here in investing: the trend is your friend until the bend at the end, right? And that's when the mean reversion comes in and you start to see perhaps a underperformance or even outright collapse in some of these outperformers as there's a change in leadership. We're at historical highs right now in terms of the concentration of the top 10 names. So expand the Magnificent Seven plus 3, there you get the top 10 concentrated names. Based on market capitalization, it's at about 30% of the overall weight is attributed to these 10%. I remarked that that's pretty astonishing, right? That just 10 names make up almost a third of the S&P 500. What's even more astonishing is when you take a look at the course of performance in 2023, that 85% of the overall return of the S&P 500, which is around 25, maybe 26% total return in 2023, 85% of that came from these top 10 names. So if you want to look up the definition of concentration risk in investing, I mean, I think this kind of current market setup that we've had since 2023 is a perfect definition. You would see it there based on the concentration in terms of the count of names coming up for about a third of the overall index weight, and 85% of that returns coming from those 10 names. But you take a look at the chart over time, and that's the blue squiggly line that's running across going back to 1995. You can see that there's another period of time that kind of looks similar to the setup that we have here, where you had a run up starting in the late 90s into about the early 2000s. That's the dot-com boom, which we know subsequently was followed by the dot-com bust. And that was a very similar, it has shades of what we're seeing today, where there was the top 10 names ran up to about 27% of the overall weight of the index. So again, similar concentration to the 30 that we're at here, at least that same type of trend. But those are really driven by those top 10 that were ascribed to be mega cap names around technology. Right. You had that run up, it looked great on that positive momentum, but then, like I said, the trend is your friend till that bend at the end, and look what happened there. You can see that the concentration starts to drop off fairly quickly over that time. So we haven't seen that yet in 2024. Time will tell. But what was also shown in the vertical bars that you have on the screen there, anything that's above zero, as it's indicated on the right-hand axis there, shows trailing 12-month total return basis is when the market cap index outperforms the equally weighted index, and vice versa. When it's a negative, when it's below the horizontal line that strikes across the middle, then that's when the equal weight index outperforms the market cap index. So when you take a look at the reversal in this concentration here around those periods of time, again, that 2000 being kind of that part that bifurcates the run up to the dot-com boom to the dot-com bust, you can see the change in leadership really there in terms of the outperformance of the market cap giving way to the outperformance of equal weight at post 2000. It looks like, again, you're kind of getting that set up here in 2024. And these things tend to seem to have some persistence. There seems to be some cyclicality there. And we're in this period where you've had this fairly long run up in outperformance by market cap indices. So time will tell.
Right.
It's going to be interesting to see in terms of, how long this can last, because that whole let it ride mantra does kind of have merit to it, because these things can last for a while. But when you start thinking about whether or not you want to continue to participate in that FOMO trade, it starts to make sense to perhaps start spreading some chips around the table at some point.
Right. So taking an allocation from a market cap weighted index and allocating it to an equal weighted index provides investors with the potential for additional diversification, and it also provides investors a nice setup if there was mean reversion, right? And some of those high flyers, started to underperform to the downside, or even if some of the performers who haven't performed as well as the Magnificent Seven start to appreciate at a greater rate.
Yeah, and it's interesting. I mean, when you say diversification, because just using this kind of two sample set universe where we're comparing the headline S&P 500. They have the same names underlying it as the S&P 500 equal weight. So you're effectively invested in the same names, but overall you are getting a more balanced exposure through the equal weight portfolio. And when you take a look at it across the various sectors, not only are the names the same, you actually can diversify once you start to aggregate up these names into their sector categorization that they're in. And from there, you can see the range of weights that each sector is attributed to within the S&P 500. At the equal weight indices, it's anywhere from about 5% to 16% of the range. But if you look at it versus the S&P 500 headline version, it goes anywhere from about 2% for three of the sectors, those being materials, real estate, and utilities, up to the other bookend of the larger capitalization names that are contained within the information tech or the tech sector. That accounts for 30% of the index. So when you take a look at that market cap index there, it really is another definition kind of image of concentration risk.
Right. Yeah, no, I think that's a great point. You're not only having 30% exposure to the top 10 names in that form of concentration risk, but also concentration risk to a single sector within the S&P 500. And there's 11 of them, right? And you tend to get that more balanced exposure in an equal weight index.
And that's why I think a lot of people were surprised when they looked at post-pandemic performance of energy, right? Energy was just off the charts in many of the times when perhaps technology and comm services, two of the big drivers of the post-pandemic performance. But in times that they weren't performing, let's say in 2022 as a good example, energy still outperformed, and the sector itself has had double-digit type of returns, I believe, each year. That idea of it being underweighted relative to the larger cap sectors in there meant that it was a diluted performance within that landscape. But if if you were to look at it within the equal weight index, it would have fared much better in terms of driving that contribution to return.
Yeah, that's a great example. And so as we kind of transition and put a close on this, what would you say your big benefits to investing in an equal weighted index?
We always talk about diversification, right?
Yeah.
First off, we've already talked a little about just diversification that an equal weight basket can bring in, especially given the current setup that we're seeing where in the S&P 500, the performance has largely been driven, especially in the course of 2023, by, as you said, a handful of names, through the Magnificent Seven. And as I pointed out, it became a true handful of names now. And as the Fabulous Five takes place in thus far in the early start to 2024, we'll see how it ends. But in that type of situation, if you do get this type of peak and then into a mean reverting type of market there, it's perhaps quite attractive to start thinking about the equal weight index as a way to diversify some of that exposure, especially when you start thinking about it from a valuation metric as well. Currently, the S&P 500 has a PE ratio of around 20. I mean, it's at 21 times right now, which is a bit lofty, relative to history, but especially when you start comparing it to the PE ratio of something like the equal weight version of this, which is at 17 times. What's interesting is, we have it on the chart now, is there's a bit of a divergence right now. When you can take a look at it going back to 1990 or so, that over time, on average, the PE ratios of both of these indices tend to move in sync with one another. But there are periods of times where they actually diverge as well. And we're in that kind of period again. And I would go back to that earlier chart that we talked about, where you have that 30% concentration in the top 10 names today. You have that period of outperformance based on this market cap relative to the return that you see in the equal weight portfolio. And on top of that, you have this divergence in the multiples. Going back to 2000, we saw that same setup in that previous chart. You're seeing that same setup today if you look at it versus the PEs, where the PE expansion that occurred going into the .com, leading to a compression in the .com bust, seems very similar, and it has that same shade of, or the similar shades that we saw back in the previous chart, where we showed the under versus the over performance of the equal weight and the market cap. But when you take a look at it here, what's interesting also is when these things do diverge, meaning that the market cap PE ratio tends to move much significantly higher than that of the equal weight index. When they converge, it's not the equal weight index PE multiple expanding up to the market cap version. It's instead the market cap compressing down into the multiple that the equal weight version is at. And with that, when you think about it from the construct of what's really driving that move, that sharp move in the PE ratios, it's the price. So with that, you're seeing a sell-off, based on these. And with the benefit of hindsight, we did see that sell-off in the .com bust. It's not, earnings expansion catching up to collapse that multiple. Instead, it's the price falling to bring that convergence there. So again, there's shades of what we're seeing there in the 2000s that might be a way to guide us to think about 2024 again, as we're seeing that divergence between these PE ratios.
Yeah, and talking about kind of that collapse from the price perspective of that PE ratio, I mean, when you think about the long-term performance of something like the equal weight versus the S&P 500 market cap, historically over time, looking back roughly 20 years, the equal weight on a total return basis has been able to outperform. It's done so with slightly more volatility, because you do have that slightly higher weighting to some of those smaller names in the market cap of the S&P 500, but over the long term, it has provided some excess returns relative to the market cap.
We're talking about in the beginning that you tend to overweight the smaller cap names in equal weight index relative to the market cap. And the idea behind that too, in terms of some of this volatility, is they are smaller cap names, so they tend to be more volatile. But there is also that growth potential, because these small cap names have the potential to grow into mid and large size market capitalization companies, and within there, then the potential for higher return is also there. And when you take a look at it over time, you've seen that outperformance that you referenced there. But also, what you didn't reference with the higher volatility, but what you didn't reference is it has very similar type of Sharpe ratio. So at least you're getting compensated for taking on that additional risk to get that additional reward there. So all in all, I mean, you can see also from the chart, they kind of wiggle and jiggle the same. So the equal weight index has a correlation to the market of just under 1. I want to say it's like maybe 2 ticks under 1, like 0.98, something like that. So you are getting that market exposure that people want. You're getting a little higher beta given the step up in vol, but overall you're getting market exposure of the equal weight index. There's a reason why people are asking and talking about equal weight indices a bit more today than you had seen since before the pandemic, or even shortly after the pandemic.
Yeah, I mean, timing is difficult, right? Especially to time when that momentum may turn into waning momentum or mean reversion type market. But it seems like an allocation to equal weight indexes could be warranted and could provide some diversification and maybe some additional upside as well relative to those market cap weighted indices, which we know are well allocated to.
Yeah,
so
absolutely.
Thanks, Sam. Really appreciate the insight and the color that you provided. And thank you all for joining today. And that concludes this episode of Perspectives. Take care and be well.